Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Strategic Pricing for Sellers.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today's podcast is about strategic pricing for sellers. Pricing of a house may sound really simple. I mean, it's easy. We just find out what the house next door sold for, add some onto that, and put it on the market, right? Well, that's not necessarily the best strategy. Statistically, that may actually cost you money if that is your method and apparatus of which you price properties. As investors, there's a lot of data that we gather. We gather it when we acquire the property. How do we find out if this property is a good acquisition? But we need to do the same thing when we're disposing or doing a disposition on a property, selling the property. The price that you choose can be the difference between whether you sell quick or whether you get top dollar, or whether the property sits on the market for months. And especially when we get into challenging seller markets, oftentimes, days on market will eat up all of your profits. So today on this episode, we're going to cover three areas. Number one, understanding the market and how to analyze it. Number two, the science of pricing and how buyers think. And number three, staying flexible in adjusting your strategy as markets change. So let's jump on in, right? Number one, first off, understanding markets. To do this, we need to do a comparative market analysis. If you talk to a real estate agent, they'll call it a CMA, which is their comparative market analysis. It's where it's going to compare the differences in the marketplace. This is not an appraisal. And I get that a lot of times with investors is like, do I send an appraiser out to give me a value on this property, especially new investors? Some of us that have been doing it for a while, we've gotten to where we're getting better at doing comparative market analysis. But newer investors, they're like, well, do I hire an appraiser so I make sure that I get the property priced right? We don't need an appraisal on the property. What we need is an analysis. But we want to evaluate many different factors because there's a lot of things that play into it. I have some investors that just take house by house. So if the house next door sold for $500,000, they think their house should go on the market for $510,000. But what if there's differences between the two houses? That plays a big role. So what we want to do is we want to look at things like recent sales. We want to look at active listings. We want to look at area demands, and we want to look at days on market. All these things play a key factor in determining a price that we're going to list a home for. And even though we're not doing an appraisal, it's essential to consider the criteria that appraisers use, like time, distance, size, and amenities, because most houses are going to sell with financing. So as an investor, you've got a flip that you're doing, or you've got a buy and hold property now that you're moving to either 1031 into another investment or one of these things. You got to realize that most of the buyers out there are going to be coming in to acquire this property using financing. Typically, finance buyers are going to be the highest priced offers because they're putting less down, and their only concern is, can I afford the payments in a normal market? Now, if you're in a huge seller's market, where we're in a landslide seller's market, maybe like back at the first part of 2021, that may not apply. But most of the time in real estate, I've been in real estate, for over 30 years, since 1989. I've been doing this a long time, and I've seen a lot of different market conditions. And in a balanced market, these are things you have to take into consideration, because the likelihood is you're going to have either a conventional, a VA, or an FHA buyer. If you have properties in some rural communities, you may run into USDA and some other financing options that are out there. But time, distance, size, and amenities matter. What do I mean by time? How long ago did the properties that I'm comparing to sell? For appraisal purposes, in most metro communities, you're going to want to have properties that have sold in the last 6 months. So it's important to have recent sales. You can't take a property that sold 2.5 years ago and use that as a comparable analysis property because the market's changed. And so the last 6 months are the critical factors. Distance, what does that mean? Typically, an appraiser is first going to look in the community that you're in for similar houses in the similar community, especially if you're in a gated community. If you're in a gated 55-plus community, they're looking for gated 55-plus communities that they can compare, the home to, because they want to find like value. And then they'll go out a half mile and then a maximum of a mile. The only time you can, as an appraiser, that you can go beyond a mile to do evaluation is if you're in a rural area and there have not been any sales. So, for instance, if you're in a more rural area, which I was for a while during my investing days up in the state of Washington, things weren't compact like I'm in the Phoenix area now. There's the house density is very great here. But when I was in the rural area, sometimes you had to go out to 5 miles, and it was an acceptable appraisal standard because of the lack of density of housing. But in most metro areas, you're going to want to stay a half mile if you can, and then a mile at max. And then size. Size matters. You typically don't want, for appraisal purposes, it's 10%. So if you have a 2,000 square foot house, you want to look for houses between 1,800 and 2,200 square feet. That is typical. Generally, when we're doing a market analysis, we will fudge that a little bit and go 15 and maybe 20% on the square footage if we can't find enough comps. But really, you want to try to narrow it down so you really do get a market analysis. And then you want to look at amenities. Does the property have a carport or garage? Does the property have a swimming pool or no swimming pool? Is it fenced? Is it a large lot? Does it have, new updates in it? And so most of us who are flipping houses, or even if we're bringing a property to 1031, normally we're putting, the latest features in so the homes, do well in the marketplace, but you want to make sure that you're comparing to other homes that have equal amenities, that the same type of cabinets, counters, garage, carport, additions, and a big one is square footage, and we need to make sure that our houses are in that square footage, have the right amenities within the same distance and the time. Those are very important when completing your market analysis so you actually know what the property's worth. Oftentimes, I'll hear investors say, well, the house just down the road sold for $500,000, but it's 1,500 square feet, and the house that the investor has is, 2,000 square feet. And they're trying to do a comp on it, and they're either going too low or too high because they're not looking at similar houses. Where we really get into this is when you use the valuating factor that you should be using, and that's the one that the appraisers use, and that's the price per square foot. And the reason why you have to stay within that 10% on square footage is because the smaller a house gets, the more expensive the square footage is. Larger the house gets, the less expensive the home square footage is. You also want to stay with the same level of homes if you can find them. If you're comparing 2 stories to 1 stories, you're going to have a property that's probably not going to get the proper analysis because single-story square footage is more expensive than 2-story square footage. First off, the demand is higher. You have people with disabilities that can't do 2 stories, so they're looking for 1 stories. You have the elderly class who don't want to do stairs anymore, so they're looking for 1 stories. And then you have the general buying population that are looking for 1 stories. They're all after 1 stories. But on the 2 stories, there's a much smaller group of people who are in the 55-plus range who want a 2-story because they don't want to do stairs anymore. There's a smaller group of people who have handicaps that they do not want to do stairs. They don't want to have the chair lift. They don't want to have some other device. Otherwise, they can't get upstairs. And so there's less demand on 2 stories. And the cost to build 2 stories is generally a little bit less. So you'll find that square footage price is different. So you want to compare all these things when you're analyzing your property. If we spend a little bit more time on this on the front end, we'll avoid some costly pitfalls on the back end. And certainly we do this when we're buying our properties, right? So a pitfall might be overpricing a house when it goes on the market, and therefore it leads to extensive days on the marketplace. And, and that causes then investors to make price reductions. Sometimes they make those price reductions too early because they realize that they've overpriced it and they thought more people would be interested in it than what they've got in the first couple of weeks. And so now they're doing price cuts and they're dropping the prices too much. And the adverse results show of desperation. A lot of times you're not going to get the same price. If you price too low, you can leave money on the table. So you don't want to price too low. It may make the house move quicker, but you always want to try to maximize the amount of money that you get. The other thing that happens if you price a property too high, you miss a ripe buying pool. Oftentimes, the best houses at the best price sell the fastest. When you overprice a house, you take your house out of that buying pool in a normal market. Now, remember, I'm not talking about an overheated market like we were in the first part of 2021, at least in most of the U.S. I mean, we were highly stimulated. Since 2023 and 2024, it's been a really tough real estate market as far as volume goes. And so we want our houses to continue to move and move quick. I can't even tell you the number of students and investors that I have had conversations with who just were sure that this was the perfect house in the perfect location at the perfect price. And once they got the remodel done, they got the house on the market, they got their home priced to what they thought was going to be their perfect price. The home sat for months and months and months. And I've talked to investors who've had houses sit for over a year during that time period. So again, this is very important that we do our analysis efficiently and effectively so that we make sure that we're where we want to be in the marketplace. Secondly, I want to talk about the science of pricing because there is a little bit of science to it. Buyers shop, first off, in brackets. And this is a thing, as a real estate broker for many years, I've had to teach clients, is that buyers shop in these price point brackets. Generally, because that's where their loan approvals are. So loan approvals don't normally come in at 327, 500. They're normally like, well, no, you're approved to 350, you're approved to 360, 375, 400, 450, 500. So pricing a property at $505,000 may miss an entire population of buyers who could afford your house at $500,000. So we need to realize that we give up something trying to get that extra $5,000, and it may be how quick the home sells. And if you're carrying a property with hard money and you're paying, we'll say 10, 12, 14% interest on hard money, that'll chew up $5,000 pretty quick. And it may be worth considering trying to maximize the ability to take advantage of the way a person's mind sits and get that house at $499,900. I mean, $499,999 is way cheaper to a buyer's psychology than $500 and $2,500. Even though it's only $2,500 difference, the psychology to a buyer says it's incredible. It's weird when you watch this happen and you study it over the years, that if something's $400,000 but something's $399,000, $999,000, a dollar difference, that the property that's a dollar cheaper will actually be more attractive than the other price point. It's very interesting. But if we know that, then we can make sure that we're pricing our properties below that threshold to increase visibility, because we want to get as many eyes, obviously, on the property as we can. Now, in stronger seller markets, where we're getting multiple offers, sometimes we'll price below those points, not because we want to sell the house there, but because we want to create multiple offers that will drive the house up to what we wanted or maybe above. So there's this emotional impact, this perceived value that buyers get out of a price point. The other thing is buyers are often very emotional. They perceive value. when there's things that develop urgency, and a lot of times it's the best house at the best price that'll develop urgency in buyers. Typically, if your house has been on the market a long time, you've had price cut after price cut, that's not something that's going to drive an emotional impact for a buyer. It may for an investor who says, well, maybe there's an opportunity here to buy this property for less because this investor needs to get out of it because they're up against hard money or whatever the deal is. But again, we want to take advantage of that emotional impact. The other thing is kitchens and baths. When you're doing the updates in these houses, think about your kitchens and bathrooms, because that drives a lot of the buying decisions. The reality is that that women make a lot of the home buying decisions, and those are things they're looking for. They're looking for functional kitchens for entertaining, and they're looking for larger master bathrooms that they can, do the things that they need to do or feel that spa experience when they're utilizing the master bathroom. I'm not saying that men don't, but I'm telling you, as a real estate agent, I have seen the things that affect buyers when we're in homes and what they're looking for and what creates urgency in those type of areas. And then obviously we want all of our homes to have as much curb appeal as we can, because we want people to feel comfortable the moment that they drive up to the property. All right, the third thing is, how do we adjust and how do we stay flexible? Because the fact is, real estate markets change. They have changed over the last 20 years. I'm just going back to the big crash that we had with the mortgage market problems that we had back in 2007, 2008. And since then, we have seen markets all over the place. COVID changed the market. It created a very hot market with low interest rates, people at home, and people having the ability now with money that was coming in from staying home, not working. They were getting government subsidies. They used all these things and leveraged homes at the lower interest rates, and it created a buying frenzy, and the market was really strong through 2021. Well, starting in about May of 2022, all that changed. As the Fed began to raise interest rates, public policy changed with the new administration, and we saw a very rough real estate market in 2022. And then we saw, probably, statistically, some of the worst real estate selling markets in 2023 and 2024, at least in my lifetime. They were very, very tough. And so we can see that there are changing markets. We are in a changing market right now. Interest rates are comparatively high. They're not historically high, but they're comparatively high to where they were in 2019, 2020, 2021. So we got a lot of sellers who are sitting on 2.75, 3.25% mortgages, and they don't want to change that for a 7%. Though we've seen some pullbacks in interest rates lately. The end of September, as the Fed's cut rates. Going into that, the mortgage bond market had reacted in anticipation of it, and we saw mortgage home prices come down. So we got a changing market, but it hasn't brought a lot of buyers back. But now things are becoming more affordable. So now is the time where you want to make sure you've got the best house at the best price that fits your margin, because it will probably sell much quicker now. Even though in my market, the Phoenix market, the average days on market have been about 90, when generally we're about half of that in a normal market. So we've still had extended days on market in our area. And there are a few places in the U.S. that are still, for whatever reason, they have turned quicker and they have gotten a little bit hotter. But most of the U.S. is still pretty tempered. I think people are still hoping that interest rates drop into the fives. So you've got to, be flexible when those things happen. How are we going to deal with this? And are we going to reevaluate our pricing? If interest rates do take a half or 3/4 point drop, does that mean we're going to raise the price on our home because now people can buy more home, or are we going to want to stay where we're at? We got to evaluate all of those things in light of what's going on. We are in still a pretty strong buyer's market. So there's some things you can do when you're in a buyer's market. You can offer to pay part of the closing costs. You can pay for rate buy downs. There's a lot of things that you can do as a seller now to make your property appear more attractive than somebody else's property. And so those are things that you need to evaluate when being flexible in a market, because again, in 2019, 2020, 2021, we weren't offering any concessions to anybody. We had multiple offers, people paying over asking price. The market was steadily going up. I mean, it was a really strong market. But 2023, 2024, and even the first part here of 2025, we have gone to offering seller concessions. And on the buyer's agent side of things, on my real estate brokerage side, we've been encouraging our agents to ask for everything they can get, because there's some sellers out there that have properties on the market for a long time, 180 days, and they're becoming desperate to sell. And the thing that I don't want you to do is become one of those people that are desperate to sell and have to give away the farm to get rid of your property. The other thing we have to remember is there's seasonal influences. Spring is always the strongest selling season. So those who can get their properties on the market, by the middle to end of January, typically are going to hit a stronger buying pool as we come out of winter and start to go into spring, which is basically March, April, May. Those are the 3 big months. There's also, some uptick that we see in our marketplace here in the Phoenix area in the fall, because what we get is we get a lot of people moving in here from other areas. Florida's like this, Miami and those type of areas. They benefit from the fall as people are leaving the areas that are becoming cold and moving into the warmer areas. So you got to know these things so that you can prepare your pricing and how you want to approach this. With these 3 strategies, you can be successful at pricing your listings to maximize the profit, maximize the sale price, and minimize the days on market. I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Check out our previous episodes of related real estate investing topics, and I invite you to subscribe today and be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcast, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.